Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you so much for taking the time to join me for this webinar. Today we are exploring for yield across the market, and none other than Will Barton from High Dividend Opportunities is joining me today to dive into two picks that he says right now are pretty primed. And we're going to get into the conversation, find out what those are and why they are set up with where we are in the markets right now. But before we dive into our conversation today, let me go ahead and get our quick legal disclaimer out of the way. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. Now, with that out of the way, this is a very important time, and I'm going to go ahead and ask Will to join me here on video as well. It's a very important time. It's a very just a time of celebration, I guess is the best way to say it, because High Dividend Opportunities is now celebrating their 10-year anniversary mark with the Seeking Alpha. So, Will, thank you for taking the time to join us today from the HDO team. Everybody over there obviously knows who you are already. But before we dive into all of the content we're going to get through today, why don't we just go ahead and lay the land? For the people that are joining right now that may not know who you are, who is Mr. Will Barton? And how did you get started with High Dividend Opportunities and get to where you are today?
Well, thanks for having me, Daniel. Rita Morwa started High Dividend Opportunities 10 years ago now. We just celebrated a 10th birthday for the service, which is quite remarkable to have continued on and grown as large as it has over the years. I have been privileged to be part of the service for 7 years now. I came on with Rita in 2019, and I was just writing on Seeking Alpha, mostly managing my own investments. And all of a sudden, I get this message from a guy who says, "Hey, I really like your writing. How would you like to write something for me?" And it kind of blossomed from there. And I've really enjoyed working for High Dividend Opportunities, doing a lot of research on high dividend stocks. My background is in real estate. Before I retired and started writing, I was an appraiser for commercial real estate, and I've really enjoyed it. I've diversified and learned the ins and outs of a wide variety of dividend investments while managing my own investments. And Rita has really been a great mentor to me over the years. And we've continued to grow High Dividend Opportunities to be the largest dividend service on Seeking Alpha.
It is the largest. I was wondering if I was gonna say that, and you took the words right out of my mouth. I mean, it is the largest community for investing groups here on Seeking Alpha. You guys have such a nice wheelhouse over there with the team and all the community, and also the picks. People like the picks. They have 4 model portfolios. We'll get into more of that later here, but for now, maybe we can go over the income method that you kind of focus on over at High Dividend Opportunities, because it kind of looks at you're trying to find that yield throughout all parts of the cycle, no matter where you are, and maintain that yield. So can you walk us through that?
Yeah, all of us on the team have all come from a background of we like to collect dividends. And I think we all kind of came about it kind of in a similar way. You know, you start investing and we get to the point where, hey, we want something from our investments today, right? We want that cash flow. When I was looking at stepping down from my job, I was at a young age. I was in my high 30s, and how am I going to manage to support myself? And so for me, income investing was a way to make sure that I had that cash flow coming into my portfolio every single year. And I think much of the team has a very similar, kind of mindset of not, I don't want to count on having to sell this in the future. When I started investing, I was very young during the dot-com bust. It was, I didn't have a lot of money. My couple $1,000s that I had invested into the dot-com bust was an awful lot of money that I lost. And it really kind of shaped my outlook on, how volatile the stock market can be, even when you're investing in companies that are long term, some of the best companies in the world, right? Amazon was fantastic, but during the dot-com bust, I was sitting on a 80% loss. And what that was to me at the time, a ton of money. And so we really focus on the cash flow that our portfolios are producing rather than approaching investing as if it's some kind of, oh, well, we're going to sell this. We're going to build this up and sell it and try to make a quick flip, hope that the price goes up. We look at our portfolios as a business. What is my business producing? And our business is our portfolio. What kind of cash flow is it producing? What can we take out of it? Because what's the point of investing if you're never going to be taking the money out? And so the income method is we've really developed it over the years. We all had an income approach that preferred looking at dividend stocks. And we developed the income method as kind of a set of baseline rules based on our experiences, our expertise, to create a cohesive system of, okay, you're going to take money, invest it in high yield opportunities. You're going to set up some safeguards. Like one of our rules is make sure that you have at least 42 different income producing stocks so that you're not reliant on being absolutely right. As great as our team is, we're not right 100% of the time. That's just the reality of investing. And so we focus on helping people build up a portfolio that's producing cash flow, and we want that cash flow to grow every single year, regardless of whether the prices of the stock market are going up, whether they're going down, sideways, whatever that noise is in the market at the time, we're looking at growing that income. And for us, I think COVID was really a transformative time for us because it was a time when prices were crashing. There were plenty of dividend cuts throughout the market, but we managed to navigate it and grow the income that our portfolios were producing despite all of the headwinds of something that was completely unexpected. And so over the last, I'd say probably 5 or 6 years, we've really focused more on the development of the education. Why are we picking the stocks that we're picking? Why do we believe that they're going to continue producing high amounts of cash flow? How can we structure our portfolios in a way that we can protect ourselves from the unexpected black swans, from being wrong, from, whatever the unknowns of the future that are going to come out, and make sure that we're achieving the ultimate goal, which, when you're looking at quitting your job, you're losing an income. That has to be replaced somehow because your bills come every month, whether the market is up, down, sideways. Your mortgage company doesn't care. Your credit card companies don't care. Your car loan company doesn't care. Your electric company doesn't care. They want to get paid every month. You need a way to do that without the disaster of selling stocks that are trading at low prices and you've already lost years of price growth because the market's in a bad mood.
Well said. Well said. I was going to ask you a couple follow-up questions here. A, how do you manage risk? B, it sounds like the community's focused on actually taking that yield out of the market, not so much dividend reinvestment plan sort of scenarios. Now, maybe that is a cohort of your community. You may know that better than I would. But yeah, let's start with the first one. How do you manage the risk that you were talking about there? Like in a situation, last April with the tariff shock, when that happened, I imagine when the entire market gets hit like that, like how do you navigate your community through it?
Yeah, and our main focus is going to be on the income, right? Tariffs are introduced. That's going to put various dividends at risk. It wasn't so much an impact on our portfolio because at the time we were mostly invested in financials. And we've actually, after the tariff hit, we've kind of started taking looks at opportunities that are more directly impacted because prices go down, yields go up. Sometimes that can present a buying opportunity. But our focus is on what does it actually mean for the cash flow of the business? Is the business going to be making more money? Are they going to have a hit on their cash flow? And then we need to we take our due diligence is focused on, how long is that hit going to be? We tend to be patient investors because, we understand that in business, there's going to be fluctuations. And so we are focused on what is the long-term cash flow of this company going to be, just like any business owner is doing when they're making decisions for their small business when they're running it, right? And, we protect ourselves by making sure we're diversified. We want to be across various sectors. Some are going to be the stick your hand in the fire type. This is just a really, really low price, really high yield. Others are going to be, very safe blue chip companies that have been raising their dividends every single year. We've been focusing a lot on fixed income in the past 2 or 3 years and focusing on things like bonds and preferred stocks that are just paying a nice, good, stable base. And that allows us to then take the more speculative positions where, hey, you're getting a lot of yield right now. We're not 100% certain it's going to continue in the future. Other ways we encourage people to protect themselves is by not planning on taking out 100% of your dividends, right? We're targeting a yield of 9% plus for our portfolio. We don't suggest you take 9% plus out of your portfolio. We suggest that you reinvest at least 25% of the dividends that are coming in. And that makes it so that you're buying more shares every single month. You can go out into the market. You have 25% of whatever dividends you received. You're reinvesting, you're buying more shares, you're collecting more dividends the following quarter. And that's really our focus, is making sure that your income is growing every month. And when that's happening, the market prices tend to take care of themselves. Eventually, people will come and buy cash flow. And our focus is always, when we're looking at earnings, what's the cash flow? Is it going to be sustainable? Is there going to be potential for the cash flow to grow in the future?
The cash flow is definitely important. And I wonder how you think about cash flow when it comes to, the macroeconomic side of things, right? We're all watching jobless claim numbers. We're watching what's happening with the Fed and the interest rates. And how interest rates obviously affect yield across various parts of the market. So when you're thinking about cash flow and the times that we're in right now, whether it's geopolitical risk of countries going after countries, whether it's oil shocks, whether it's, name it, the administration's probably said something about it. How do you think about the cash flow right now, the beginning of 2026?
Right now, we are in a fortunate time for dividend investing because ultimately dividends are treated by the market very much, in correlation with the risk-free rate. What kind of interest can you get from U.S. Treasuries? And one way of understanding most dividend investments is there's going to be a premium on top of it to account for whatever, economic risk that there is, and that they're going to trade at a premium over the U.S. Treasury rate. So when Treasury rates are higher, investors have that option of, oh, well, I can get 4 or 5% while taking on absolutely no credit risk. That's going to reduce the value of pretty much any investment that's primarily designed to pay dividends. And so the result is prices are lower. If prices are lower, we can reinvest at higher rates. Our portfolio average, we always say, we're targeting 9% plus. Our marketing has often focused on, having a model portfolio that's producing an average of 8 to 10% right now. Back in 2021, when interest rates were 0% and, the 10-year and the 5-year and all that was, in the very, very low, 2%. At that time, we were struggling to find opportunities where you could get that 8% plus yield without taking on excessive risk. And you always have to consider that, right? It doesn't do you any good to buy something that's yielding 10% if it's not going to be there next year, the year after, or whatever. And so we try to strike that balance. And in today's market, our portfolio has been yielding over 10% for over the last year and a half, solely because interest rates are high, because prices on dividend paying investments are low. For many of them, the valuations on the stocks are near their 10, 15, 20-year lows at the same time that the S&P 500 is trading near, 15, 20-year highs. So that's really been a great buying opportunity for us. It doesn't look the greatest when you're looking at the total return and you're seeing that prices are down, but we're seeing the income is being generated. We're collecting the dividends and we're getting paid while we wait for the market to turn around. Like we've really seen, last month, we've kind of seen that start of a rotation into value stocks, into dividend paying stocks. It's not the first time, probably won't be the last. We'll see how long it lasts, if this is the one that sticks, or if we see, interest rates stay higher for longer and we get to keep reinvesting at these higher yields. Ultimately, the higher the yield, the higher your income is growing.
Ideally, right? As long as those are safe yielding assets. And you keep talking about getting paid to wait. So I'm kind of curious. There's been some questions coming in about, what are the portfolio sizes that you need for something like high dividend opportunities to achieve this 9% yield? But the other question I want to ask you on top of that is, how long do you stay in these picks traditionally? Because I know you cover many different asset bases over there at High Dividend Opportunities.
Yeah, I mean, our turnover rate is relatively low. Last year, we had 10% turnover in our common equity portfolio. In our preferred stock and bonds, it's more rapid. We had 15% turnover, and that's because, holdings are being called, holdings are maturing. We have a bond ladder set up so that we have relatively equal amounts of bonds that are maturing every single year, providing you that lump sum of cash that you can then reinvest at whatever the current market rates are. We are definitely investors that fall on the patient side. Even when an investment gets into trouble, we generally don't just run around and panic and rush to dump it. We will sit and hold it. If we believe that the investment is going through a cycle and that there will be the other side of the cycle where it recovers and cash flow comes back up, we are certainly willing to hold it through the entire cycle beginning to end. The pick that we'll talk about today is kind of a classic example of that. It's 3 years ago, people were telling me it was a horrible pick and that I should apologize for suggesting it. Today, people are saying, "Oh, wow, this is a wonderful pick and you're so wonderful for picking it." And really all I've been is kind of consistently pounding the table for 7 years. So that's our outlook is really when we buy a stock, we plan on holding it for at least 3 to 5 years. We'll sell it if either the price gets so high that we're just like, this isn't worth holding. The market wants to give us a high enough price, we'll sell it. We'll invest in something that's cheaper and a higher yield. And occasionally when a company makes just a dramatic change where we see that this is never going to recover, that's when we'll sell.
All right. And with that being said, I do want to kind of transition now. We've talked a lot about how the method income works and a little bit about macro, not too much though, but about your picks, because I think that's what everybody's here for.
Yeah.
When we first talked about doing this webinar, you kind of laid out the land as to why this specific sector you've been so focused on for so long. And you were giving me history all the way back to the great financial crisis, actually, if you remember, and how this sector has been kind of left out of the run. But you're saying now could potentially be the perfect opportunity. And there's a big, bold call at the end of this as to why this is your call. I wanted to see if you could just take a second, maybe give a history before we get into the actual pick of mortgage-backed securities.
Yeah. Agency mortgage-backed securities, it's a very unique asset class to the United States. It all started back with Fannie Mae and Freddie Mac. They're government-sponsored enterprises that started for the purpose of increasing liquidity in the mortgage market. How can a person go out and get a 100,000, 200,000, well, nowadays closer to 300,000 or 400,000 loan for most people, and for 30 years at an interest rate that's well lower than anything that they have on their credit cards or their cars or whatever, right? The reason that's possible is because Fannie Mae and Freddie Mac buy up the mortgages that, fit their underwriting qualifications, and they put a guarantee on it. If the mortgage defaults, Fannie Mae and Freddie Mac are going to buy it back at par. And the result is that for investors in these mortgages, there's no credit risk. If the borrower defaults, Fannie Mae and Freddie Mac are buying it back. And that makes it a very appealing asset class for investors who have large amounts of money and have very low risk tolerance to be buying up. You'll find agency MBS is owned by a lot of banks. It's owned by a lot of insurance companies. These institutions that have a lot of liquidity needs where they need an asset class that they know they can borrow against or sell really quickly in any conditions to meet whatever their cash needs are at the moment. And so the agency MBS market has become quite huge over the years. It's well into the trillions. And it's what makes it so possible for people to go out, get their 30-year mortgages. And it provides a slightly higher interest rate than US Treasuries. The one thing that, from an institutional perspective, isn't wonderful is that borrowers can repay anytime they want, right? You can take out a mortgage. You are absolutely free to refinance it. You're absolutely free to sell your house and pay it off in full. And so you have a little bit of uncertainty as far as the flow of funds, how long it's going to last. But it become a major portion of the U.S. financial system. And the agencies back during the Great Financial Crisis, they were the quintessential too big to fail, right? When mortgages were defaulting rapidly, the government did step in. They did put them in receivership, and that they're still there right now. They're still being managed by the Federal Housing Administration, but the mortgage system itself is still running strong. They're still being issued. It's still an option that's available for investment for banks and institutions and agency mortgage REITs, which is what we're going to talk about today. They make up a relatively small portion of the demand for them, but what they do is they buy on a highly leveraged basis. They buy long-term mortgages, usually 30-year. Occasionally, they'll buy into the 15 years, depending on pricing. And what they do is they borrow short-term in what's called the repo market. The repo market is the market that it's the market where the Federal Reserve sets the Federal Reserve rate, right? When they say we're going to raise interest rates, 25 basis points or cut interest rates 25 basis points, the Federal Reserve is going into the overnight repo market and they are borrowing or lending whatever amount is necessary to get the interest rates to where they want it to be. So it's a very liquid borrowing market. They can borrow at very high rates, usually 90 cents to 95 cents on the dollar. And these mortgage REITs borrow in those short-term markets. They hold the long-term assets and they profit from the interest rate spread between the two of them.
Yeah, it sounds like a simple enough business. So it's kind of interesting how it's one of the sectors not a lot of people talk about unless you really get into the yield side of things. But I was hoping that maybe we can dive into the first pick that you brought for us today, and I'll go ahead and get things thrown on the screen here. But I'll let you dive in. What is the pick that you brought for the MBS agency we're looking at here today?
It's Annaly Capital Management. The ticker is NLY, and this is the longest lasting mortgage REIT that has been doing this strategy since I want to say it was late 1997 when they IPO'd. And they started implementing this strategy and have done it ever since. And they've had a very long history, gone through the dot-com bust. They've gone through the great financial crisis when there was the mortgage meltdown. And they've continued to persist, and they are right now the largest company in this subsector. You can see on the price there, you have Generally flat. It went up a lot during the dot-com bust. It spiked up a lot post Great Financial Crisis. And in recent years, it's trended down. And the reason why is that their book value is highly correlated to what agency MBS are trading at. Agency MBS are considered, zero risk, zero credit risk investments. So what happens is they are highly correlated to the price of US Treasuries. When interest rates go up, their price goes down. When interest rates come down, when the market is crashing and investors are panicked over equities, they're buying US Treasuries, US Treasury prices go up. The Fed is usually cutting interest rates during recessions, and that's really the periods where they thrive. And you'll see higher prices and also higher cash flow from them. Yeah, if you scroll down, okay, you can see it. I can't quite see on my screen, but yeah, their dividend history, you can see that it's all over the place. They've definitely worked on stabilizing it in recent years. And this is because they're making a financial trade, right? They are buying MBS, they're borrowing at short-term rates. So they're not building any kind of infrastructure. They're not bringing in customers that are going to increase their, cash flow every single year. It's a pure financial trade. We're buying at this price, collecting this yield, and we're borrowing at this price, paying this yield, and they're collecting the difference. And so the cash flow is going to be highly variable between what that difference between short and long-term rates are. And we've seen everywhere from something to 8-9% return on equity. Last year, their new loans that they were buying, they were looking at 17 to 19% returns on equity, is what they expect. And it's always high. It's not always the same. And I think that's what gets a lot of people to kind of give this sector short change because, oh no, it came down. They'll look at 2012 when Annaly Capital had 6.5% and 7% mortgages. They were paying, 0.5 to 1% on their debt. Well, and new mortgages were coming out at 3 to 4%. So over the years, obviously the 7% mortgages pay off. That little windfall starts disappearing and it comes back down. Where we've been sitting recently, and this is why I've been very bullish for the past several years, is because they've been buying up 5, 6, 7% coupons, and the 3, 4%, or even the MBS that were being issued in 2021 were 1.5% and 2% coupons, right? Because mortgage rates were so low. They've been buying these higher coupon mortgages, and right now the Fed rate has been high. Their borrowing rate has been relatively high, but we're starting to see that point now where everything's starting to come down, and they're starting to collect a very wide spread, and that's really been kind of a reinvigorating boost for the sector. They're getting higher income, and their book values are recovering. And that's why we saw 30% plus returns last year. And this is just getting started because mortgage rates are still, the current coupon right now is still in the 5%. It's been 3 to 4% through most of the 2000s. And we believe that it's headed back down that way. And that's going to be another windfall for them that we saw back during the Great Financial Crisis.
Right. So, Will, I want to make sure we drive that point home because when we were first talking about this, one of the questions I asked you was, what about I think it's something like 30 something percent of all homeowners that locked in or refied to these low interest rates during COVID what happens with these loans that are sitting on their books. And you were actually explaining to me how they rotate those off the books so that they can actually go out and obtain the higher yielding assets and capture that spread. Did I have that right?
Yeah, well, mortgages are amortizing, right? Which means that every month you're paying the principal. It doesn't matter what your interest rate is, you're paying principal on your mortgage every single month. And so every single month, they're collecting the interest plus they're collecting the principal payments. And so when you have something that, is sitting there at, 2 or 3% or whatever, they're getting that principal payment, they're reinvesting it in new mortgages that are at 5, 6, 7%. And that's a positive trend for them. It's slow. It's not something that, oh, hey, mortgages went up. It's all going to happen overnight. That's why we didn't see a huge boom in 2022, 2023, because they've been very slowly rotating it over. Occasionally they'll sell the lower coupons if they determine that, the economic return on the higher coupon is going to be better. They really didn't, they weren't doing a lot of buying of MBS in 2021 and 2022. They really pulled in their horns and just kind of sat there and let the size of their books drift down. And they really started leveraging up kind of late in 2024. In 2025, we saw them issuing a ton of equity and increasing their books back over $100 billion. So that's one of the things that management can kind of make the decision. And some managers are doing better than others. We saw some of the weaker companies in the sector that just completely went, let's go buy everything, right? Let's just keep going, keep pushing the dividend really high, keep the yield really high. And we saw a lot of them have to start cutting last year. With Annaly, we saw them, sit back, be patient, wait for the pricing to be right, and then say, okay, now we're buying everything that we can. And they've been very active throughout 2025. According to the earnings calls, they intend on being very active in 2026 in buying these higher coupon mortgages and letting the lower coupons just kind of organically roll off.
So, Will, can I ask, is that what we're seeing here in this total return chart that you guys put together, or the total return for NLY here, where like I'm looking at it post COVID, right? It increased a little bit, but then it had that wind down effect where it kind of came down and met that S&P 500 total return, and now it looks like it's skyrocketing from here.
Yeah. Yeah. And the main impact, the main impact of that decline was solely in price. Agency MBS fell off a cliff because they're tied to US Treasury rates. And so they went from trading at large premiums to par to trading at discounts to par. And that, the book value, since they are leveraged, it's going to be very sensitive to those movements. The other aspect that we saw with agency MBS during the period is it underperformed US Treasuries, right? They're correlated, doesn't necessarily mean they're tied at the hip. And so what we saw is MBS prices were falling more quickly than US Treasuries because as Treasuries and interest rates were going up, we saw, banks were less interested in them. We saw the big institutions that become less interested with them. And the Federal Reserve itself simply stopped buying agency MBS. Since the great financial crisis, the Federal Reserve was the largest buyer of agency MBS every single year. And they decided to go into quantitative tightening, which means that they're reducing their balance sheet. And they just simply stopped buying agency MBS. And that took away a major buyer in the sector that hasn't quite fully been replaced yet. It's starting to become less relevant because you're starting to see, agency MREITs stepping in, buying some. You're starting to see some hedge funds starting to buy some. You're starting to see the ETFs that focus in this sector starting to buy some. And so that's kind of more of a technical price impact. But for a variety of reasons, we saw agency MBS sell off a little bit more aggressively than US Treasuries. And that was a big hit to book values that we really saw starting to clean up last year. And that's why book values went up a lot last year. And as you can see here on this chart, we're just looking at the cash flow, right? This is the what would happen if you invested in NLA at IPO and reinvested the dividends. The cash flow has grown substantially over time, even with the variations of dividends that occur with, whatever's happening in the markets, and it becomes a little bit more profitable, but a little bit less profitable. Like I said, they haven't always paid a consistent yield, but it's always been high yield.
All right. So that's NLY for everybody in the MBS background. But you said there was another stock we were talking about. Why don't we go ahead and throw that name out there, and then we can get into your big bold call before jumping into some Q&A.
Yeah, Agency Investment Corp is a sister company to NLY. They're very similar. AGNC originated during the Great Financial Crisis is when they IPO'd. So they kind of IPO'd at what was the peak of the market, right? During the Great Financial Crisis, you had the best of all worlds. You had a lot of legacy mortgages that were out at the 5 to 7% coupons. And even though mortgage rates collapsed and people could borrow a lot cheaper, even when you go out to refinance your mortgage, you still have to go through the financial checks. You still have to have your credit rating pulled. And well, people were losing their jobs. So it didn't matter that they could save hundreds of dollars on their mortgage. They couldn't refinance. And so for these companies, that was kind of that golden era of you have all these high mortgages and they can't prepay. And that was the theme of really every earnings call that you had back then, from probably 2009 through 2013. What's the prepayment rate? What's the prepayment rate? Are people, are they improving their credit? Are they able to refinance now? And so AGNC is more or less a pure play on agency MBS. They're using this strategy. They don't really have any significant exposure to side businesses. And you can expect to have very similar results from them compared to NLY. They do have, a little bit different hedging strategies. Sometimes they're a little bit different in how they decide to leverage up. And so those decisions will result in slightly different returns quarter to quarter. But AGNC they've been trading at the larger premium. And that's been a big advantage to them because they've been able to issue equity at better prices. And they really blew up their portfolio last year. And, we expect them to be able to continue doing that through 2026, raise equity, deploy more capital. Well, the spreads are really good right now. And we don't know what the Fed's going to do. We don't know when they're going to do it. But it's a pretty safe bet that interest rates are going to continue coming down before they start going up.
Yeah, I know everybody's eyes are on that. Now, I wanted to ask you, what's the play here around, these dividend history payments? So obviously when times are good for the company, it looks like they paid out very significantly to their dividend, but also their share price was dramatically higher. So do they maintain yield? Do they grow yield? How does it work when they start to increase their dividend as the share prices go up?
Well, what happened, especially if you look back there during the GFC in 2008, 2009, 2010, they're structured as REITs, so they're required to pay out their taxable income. And during those periods, when you have a sharp change where you go from 5, 6, 7% coupons down to 3, 4% coupon mortgages. Well, a 7% coupon mortgage is way more valuable than a 3% coupon mortgage, right? The only way that they're going to be trading at significant premiums to par value because you're getting a lot more cash flow. And so what happened during those eras is they were producing too much taxable income. They decided, oh, well, all right, we could sell this 7% mortgage right now. We can realize a big gain and reinvest over here. And so when they were doing that, they're realizing gains. It's all taxable. They have to distribute it to shareholders. Distribution skyrocketed, and during that time, both NLY and AGNC paid tax penalties for not distributing enough fast enough. And so it's really kind of that windfall effect of, the market conditions aligned and just gave us a ton of money. One thing I like to kind of compare it to is kind of like oil, right? An oil company, when oil's being priced at 110 to $120 a barrel, is going to be making a bunch more money. But we all know that the market's going to catch up. Oil prices are going to moderate eventually. You're going to come back down to earth. And when it does, you're just not going to be making as much money. So you kind of get that windfall effect. And that was really what they saw during the great financial crisis. And, from there, it was really just coming back down to normal. If you look at NLY's dividend, their dividend today is very comparable to what it was when they IPO'd. It was the big leap that it was extra money, right? They were just doing fantastic. It wasn't sustainable. You can go listen to the earnings calls back at those times, and management told you this isn't lasting forever. It's just we're making a ton of money and we're sending it along to our shareholders, which is, from my perspective, yeah, if a company makes a lot of extra money, I like that they pay it to me.
Yeah, I agree with that. I'll be in that boat as well. But definitely you're laying out the land of the boom bust cycle, right? I guess we're talking about how we started this webinar, how high
Yeah.
dividend opportunities invest for yield across the entire cycle. Different moments in time require different strategies. But now I'd like to move in to this call that you made that I think everybody needs to hear from, because when high dividend opportunities, when you and your team make calls, they stand out. And this one definitely stood out to me. So why don't you go ahead and share with everybody what you're thinking for the path ahead?
Well, I mean, our big call is that we believe interest rates are inevitably going back down to zero. I know a lot of people right now are focused on, well, what's inflation doing right this moment? Everybody's focused on the next Fed meeting, or what's going to happen the next Fed meeting, or at most they'll look out towards the end of the year, right? And I think a lot of people have kind of lost sight of the overall interest rate cycle. We've been looking at interest rates have been declining really since the 1980s. And, the fundamental factors of the economy that drive interest rates, the main things that you have is population growth, right? More people are moving into a country, more people are being born in a country, and you're going to have more workers, more demand, especially when you get into the high consumption population. People in their 30s and 40s are spending most of the money that they make. The number of people who are sitting there saving it is not nearly as high as it should be. And, as people get older, you start getting into your 50s and 60s and 70s, their consumption tends to decrease, for a variety of reasons. They're not working as much. And they tend to kind of fall into their comfort levels of what they like to do, and they don't really change it much. They're not raising families. They're not buying new cars. They already bought cars. They're not buying new houses. They already live in the house that they're comfortable in and want to live the rest of their lives. I've told my girlfriend I intend to move one more time, and that's going to be the last place that I live because I don't want to move anymore. And so when people get into their 60s and 70s, you have this lowering of demand. When people are in their, 20s, 30s, 40s, that's when they're really pushing that demand. And so the population demographic changes that we've seen throughout the country, it's been a pretty steady slowdown. And ultimately that leads to lower inflation. You can have these short-term, disruptions like COVID was, where, supply was just shut down and all of a sudden you've disrupted the supply side and it's gone. But the long-term population dynamics aren't going to change. It's still there underlying. And as the short-term influences fade, you're in a situation where you're going to have chronically low inflation. And how does the Fed respond to chronically low inflation? They reduce interest rates. And I think another very important factor of this is the technological change. In 2000, the internet was coming out. It's changed all of our lives. But in one of the ways that it's really changed things is it's made the world smaller. It's made it more competitive. It's reduced the amount of time that is devoted to a lot of jobs. It's made things a lot more efficient. And so in that respect, you have higher supply, you have easier shopping. You want to buy something today, you go on the internet and you can compare 100 prices from a dozen different places in 30 seconds or less. And so you have the technology was a very deflationary force. I think AI has the capability of being as deflationary and maybe even more deflationary. If you listen to some of the people who are very bullish on it, I'm hardly the person to be an expert on AI, but I've used it myself from time to time, and there's a lot of things that it makes a lot easier, and that's going to improve the efficiency of the supply side, and that means deflationary tendencies. And so these long-term deflationary tendencies haven't gone away. They've possibly become even more aggressive than that they were. And I think a lot of people are still focused on, well, we saw this big inflationary hike, right? And if you go to the next slide, we can take a look and compare it to our last inflationary hike, um, which was back in 1990. The consumer price index shot up, not quite as high, but you can see how long it took for it to come down. The red line I have going across there is where today's core CPI is, and it was the mid 90s before we got down from that. 7 years is how long it took for us to come down from that inflation cycle. And we're only 3 or 4 years in right now of coming down from the peak of the inflation cycle. So it's not unusual for these things to take time to go through the economy. The economy, by its very nature, has a lot of momentum. It's huge. There's always thousands of factors that are all pushing at one time. But this long-term trend of relatively low inflation, I will not be surprised at all if in 5 or 6 years the Fed is worrying about how can we get inflation up to 2%, very much like it was in the 2000s, and that will lead to lower interest rates. And that long-term trend of interest rates coming down since the 1980s, I don't think that's going to change. I believe we will be back into a world where people are asking me, well, what do negative interest rates mean? Which was kind of a topic of conversation in 2019, which, seems like a long time ago now, but it's coming back. The long-term dynamics of the economy have not changed. COVID was a very unusual disruption. Possibly we have another disruption along the way. That's the way the world works. The unexpected happens. But the long-term dynamics for the United States is our population growth is slowing. People are having fewer kids. Our population is getting older, and our supply at the same time is getting much more efficient. We're getting better at creating things. We're getting better at creating value with less labor. And that means deflation, which in the long run means lower interest rates, which, for agency and NLI, that's great news for their business models. For dividend investors like us, well, I mean, it's great news in the sense that we can expect prices to be going up, but you're really going to have to work a lot harder at finding those opportunities where you can get 8, 9, 10% yield if we go back to a zero interest rate environment.
That's a very bold call, sir. And obviously, we can't predict the timing of it, but it'll be quite interesting to see how this plays out in the years and decades ahead. I know we're all watching, as you mentioned, the technology revolution now is AI. Obviously, internet was different back in the day. Seeing how it affect productivity led to new marketplaces being created, right? As you mentioned, ordering things online like Amazon, or the one I think about is, without the internet and technology and web, would we even have the app store on phones and have what all the billions of dollars of value that created? So it's an interesting time, but you think about the supply of homes, demand of homes, And I think my only question for you is you laid out inflation coming down, inflation coming down, inflation coming down, and population growth decreasing and population decreasing. What about jobs? Real quick. Maybe we can wrap this in like a minute or two. What's your thoughts about how the job market is going to play out here? Is that also going to continue to be strong, at least leading to that pullback in rates or
Well,
maintain? What are your thoughts?
I think we're generally going to see a weakening job market. And it's one of those things where initially, as you have the technological change, and I think there's a lot of other factors in the economy right now where companies are kind of in a wait and see. They're not really eager to expand. Consumers aren't really feeling strong right now. I think a lot of companies are just like, okay, let's just hold back and not hire. And so I think the job market is going to go through a downturn, which will probably, inspire the Fed to be a little bit more aggressive with its rate cuts. But long term, as you pointed out, technology created a lot of jobs. I mean, I wouldn't be doing this today without the internet, right? I mean, I doubt I ever would have sat there and started writing articles, mailing them into a magazine, and the old school way of publishing. I ended up writing on Seeking Alpha because I was reading an article on Seeking Alpha, and it said, if you disagree with this article, go ahead and click here and you can submit your own. And I was just like, oh, hey, let me do that. And it kind of started as a hobby. And so with the technology, you have a change in jobs, which always creates the disruption where people will initially lose their jobs, but then you have the creation of a lot of different kinds of jobs, um, different kinds of things that society will find important and valuable. In 1800s, you never would have had a professional football team. Nobody was going to be making a bunch of money playing sports. It just wasn't going to happen because people were more worried about feeding themselves. And so as basic needs become easier and easier for society to meet, you're going to lose jobs in the people who are working in those sectors. But on the other hand, we can still provide value to each other. And that's what a job is. It's providing value to other people in a way that they appreciate enough to give you money. And that's not going to go away. The nature of work will change. The primary industries will change. But I am a very much a free market guy. People will find ways to provide more value to other people, and it will probably be better for everybody in the long run. In the short run, if you're working one of those jobs that all of a sudden disappears, well, I feel for you. I was working in real estate when the great financial crisis came around. It wasn't fun. It changed my life dramatically, which at the time felt horrible. And in the long run, I can look back now and say that it was definitely a net positive for me.
Yeah, I'd say so. That's a great place to wrap up everything. And we're going to dive into a question here in just a moment. And actually, you sparked me of the example that I always think about is when it comes to jobs and things changing throughout history is, nobody goes around cities and lights the gas lamps at night anymore. And that was a
Yeah.
job. And things continue to innovate and things continue to evolve. And we will continue to. The economy is going to work itself out. Society will work itself out. And we like to think there's brighter days ahead, even during the tough times, right? But all that to say, not to get too emotional on the ethos side of here things. I do want to encourage everybody real quick before we dive into some questions. As we mentioned at the beginning of this webinar, High Dividend Opportunities is celebrating their 10-year anniversary here on Seeking Alpha. And their platform has so much knowledge of what you're looking for, whether you're looking at a baby bonds portfolio, preferred shares, your stock equities, or looking at mortgage-backed securities. Will, Rita, and the team have you covered. I highly encourage you to go check them out. They're actually running a very abnormally special discount right now, which I've never seen before. I believe it's 34% is what it comes out to, but it is $495 for the first year of High Dividend Opportunities right now during this 10-year anniversary moment in time. So I'm gonna ask the team here in the back if you could drop the link in the chat here for everyone. You can check it out today. And if you're watching the replay, you can find that link beneath this video as well. But High Dividend Opportunities, go check it out. I mean, there's so many testimonials. I wouldn't even know where to start sharing, but there's been a lot of positive feedback in their group. So I highly encourage you to check it out. There's a reason they're number one on Seeking Alpha. I'll put it that way. All right, well, we got to dive in here. There's some great questions that have been coming in during our conversation here today. First one I want to dive into is there was a question about, does it make sense for somebody to hold both NLY and AGNC in the same portfolio? When you're laying this out, making them sound like they are pretty much the same.
I do. I've held both of them for many years. And the reason why is, yes, their performance is going to be highly correlated. But the way I look at my portfolios, we try to limit our positions to any one ticker to 2 to 3%. Um, but you don't necessarily want to be invested only 2 to 3% in a sector. AGNC and NLI are definitely both the cream of the crop in their sector. And so, yeah, own both so that you can have more exposure to the sector and you protect yourself from, what I call the FBI test, right? You don't know what company is going to all of a sudden have the FBI raiding their offices. Nobody, WorldCom, Enron, they were all great companies that, yeah, everybody, they were wonderful on paper. They looked great. And that's one of those risks in the stock market that you can't quantify. You can't say, oh, well, this company is definitely safe and this company definitely is not. They were well-respected companies have just totally gone sideways because unfortunately, sometimes humans are dishonest. And so we do the FBI gut check. If you wake up tomorrow morning and you see this company being raided by the FBI, something completely out of left field that you didn't expect, and the stock is tanking, how are you going to feel? Your goal with every investment should be you can brush it off as bad luck and move on to the next one because your retirement is way too important to be dependent on everybody in the world being honest. And so by diversifying even within the same sector and having 2 or 3 companies, that just kind of protects you from that risk that, the SEC filings might not be accurate. Somebody might be doing something dishonest. I'm not saying that I have any reason to suspect that anybody at these companies is. It's just one of those risks that as investors it's real and it's always completely unexpected. It's often some of the most popular companies that it happens to. We actually had an article on that, I don't know, maybe a month or two ago, about fraud in your portfolios. And so it's just a way to protect yourself and you're going to get very similar returns. You're going to get, very similar results, but you protect yourself from that management question of whether, something is going to change, or New Tech. One of them used to be one of my favorite companies in the world. Love them. It was a BDC. All of a sudden, one day they came out and said, "We don't want to be a BDC anymore. We're buying a bank." I couldn't sell it fast enough. And I was so disappointed because they were my favorite BDC for many years. And I think it was a bad decision by them. Management thinks it was a good decision. They're making decisions that they think are right. Sometimes you're going to disagree and you can't control it. You can't predict when that's going to happen. So having a good diversified portfolio where you have, 2 to 3 picks in any given sector, so that you're insulated from that kind of unexpected black swan that, they happen.
Yeah, they sure do. Got another question from you here from Ken. Does NLY and AGNC, do they issue 1099s or K1s for all the retirement?
They're both 1099s. They are qualified under the tax code as REITs. So they most of their income will fall under the 199A deduction, which you can Google that, and it's not quite as good as a qualified dividend, but it is a little bit of a tax break for most taxpayers.
All right, thank you there. Follow-up question on your portfolios for high dividend opportunities, because as I mentioned, you have 4 of them, as well as the portfolio tracker. I didn't even mention that. To keep track of everything. How many positions were in each of those portfolios? And is that based off of just high dividend opportunities method, or is there a specific reason that is those numbers?
Well, we currently have 48 picks in our core one and core two portfolios, which that's our common equities and our funds. We don't really have a set number We kind of add opportunities as we see them. We remove them as we have opportunities. But we're usually in that ballpark because, like I said, we do recommend that you hold 42 different holdings, and we don't expect our members to follow us in lockstep. I think it's a great idea to own the whole portfolio. I own the whole portfolio. I know Rita owns the whole thing. But people have varying opinions. Some of our picks are higher risk than others. Some people like to avoid the high yield, higher drama risk holdings and stick to something a little bit more conservative. So we like to keep it around that 50 mark so that people have options and still can follow the overall plan. And then in our preferred and baby bond portfolio, I believe we're currently around 70 holdings on that. Um, those are holdings that we buy with the intention of holding until maturity or until they're called. We've grown that portfolio a lot over the last 2 years, mostly because interest rates are high, and that's kind of where we've seen the most value. We're slowing down a little bit on that because interest rates are starting to come back down. Prices are starting to get closer to par. We're being a little bit more strategic with our selections there. So overall, it's a very large portfolio. We're usually around that 130 holdings total combined between the two of them. And that's why we have a whole team to keep up with it because it's a lot to keep an eye on. But with the fixed income portfolio, we had 18 holdings or 15 holdings that were called or matured last year. So we're constantly getting that inflow of getting our par value back out and identifying the next opportunity.
All right. Now I know we're hitting the top of the hour here, so I was going to ask you one more question, and then everybody else, if you have outstanding questions, you want to reach out to Will, you can do that here on Seeking Alpha as well, and reach out to him to ask these questions. But I wanted to ask you this one that came in from Jim earlier. He says, for someone who is retired and 67 years old, how much of the portfolio do you think should be in high dividend opportunity versus stocks for future growth against inflation?
I will say that it really is a lifestyle choice. Personally, I own a mix. I started buying growth stocks when I first started buying stocks. I have a few that I've held on to forever. People always laugh at me in chat because I say, "Well, I'm not selling that. That position's old enough to drink. Why would I sell it?" And so it's what are your goals? I think the number one priority is make sure that you have enough income coming in that you're paying your bills. And that you're confident that your bills are going to be able to continue getting paid because at the end of the day, that's what we're all here for. If you want to expand and try to identify the next great thing in AI, I'm the last person you should ask to identify that company. But we do have a non-HDO chat where we have a lot of members who have a lot more experience in those categories. And, they'll talk about what they're buying, and things that they're interested in. And I really think it's a nice dynamic to have that solid cash flow coming in that your bills are paid. And then you can take a little bit extra and speculate into those things that could, become the huge companies. I mean, I've held Amazon forever. I've held Netflix forever. And I invested what was a little bit of money. It was a lot to me back then, but they've grown up, and they're big positions for me now. And I just hold them because I don't need to sell them because my income's taken care of. I've got plenty there for me to fall back on. So I'm a big proponent of mixing it, but I bought Amazon because I shopped on Amazon. I was a Prime member and I was a book nerd. I bought Netflix because I thought it was really cool to get DVDs through the mail. That's not really a great investment thesis, but we have our expertise. We're going to provide you the income stocks, but if you want to take a portion of your income and speculate into the growth, it's definitely a great way to structure your portfolio. And there's plenty of resources, plenty of people are talking about the opportunities there.
Well said. Well said. Well, let's go ahead and wrap it up here. Everyone, thank you so much for taking the time. Again, High Dividend Opportunities 10-year anniversary sale going on right now. $495 for your first year. I'm being told it'll never be that price again, pretty much. They're saying for many, many years to come, they may never see that price again. So if you want to check it out, now is the time to do so. And hopefully, you have found something very informative in this conversation that we've had. I know around MBS, that was something foreign to me, and Will has opened up his incredible knowledge base to all of us. So, thank you so much, Will. And for the entire team at HDO, thank you for 10 years on Seeking Alpha. We appreciate all of you and your community, which I know some of you are watching with us right now live. We hope to see you here in the next webinar. Everyone, have a great rest of your week. Take care.
Yeah, thanks, Daniel.